cash flow analysis and investment decisions. This is part 2 of chapter 9. Following are the learning outcomes from this part. After having gone through the preparation of cash flow estimates and conducting net present value analysis on both the cash flows as well as accounting income to infer that the results so produced are different for each type of analysis, in this presentation, we analyze the adoption of a new project by a company. We estimate different types of cash flow activities that we described before, and we make a recommendation on the feasibility of a new project. So, calculating the cash flows broadly involves different type of activities as follows. First, there is investment cash flows. Investment cash flows typically involve purchase of machines or fixed assets, are typically not recurring. They don't occur again and again. Once we set it up and get it going, then the machine just needs regular maintenance, which goes into its operations, and then we salvage it or scrap it at the end. This is where the depreciation part comes in. So typically the initial setup cost is depreciated using different ways. The most popular is a straight line method. The second is financing cash flows. These are linked with initial setup costs and generally are involved with using how to raise the money required to fund the initial cash flow, maybe set up the working capital, etc. So that's the financing cash flows. The third one is working capital cash flows, typically involving initial investment in inventory when the project is being built, so a cash outflow, and at the end, liquidation of those short-term assets and disinvestment from working capital to generate cash. The last one is the most important one, operating cash flows. So operating cash flows are essentially operating profits that are coming from the successful running of the project. So the most important thing is the revenue that's generated through sales, and then typically the expenses that are allocated to those sales on direct as well as indirect. So the operating cash flows are typically measured in three ways, direct and indirect as well. So capital investments involve initial investment and the terminal cash flows. Since the initial investment is written off through depreciation and the project, by the time it's complete, the initial investment is completely written off the books. If we are able to salvage or scrap that plant or machine at the end for a positive cash flow, because we were able to take accounting benefits of taxation on the depreciation, we have to pay tax on this final salvage value at the end of the project. So for example, let's consider this project in which we make an initial outlay of 75 and then no other capital investment cash flows occur from periods 1 through 4. At period 5, it's liquidated and a cash inflow of 6 occurs net of taxes. So let's assume that this is net of taxes. Now cash flows for the same project by change in working capital is accumulation of working capital. At time t equals 0, we invest 7. At time t equals 1, we invest 5 more. And at time t equals 5, we liquidate 6 of whatever is there. So inventory level climbs at the end of, at the beginning of period 1 by 7. It climbs to 12. And then it stays at 12. And at the end of the period 5, it shrinks to 6. So that's the cash flow occurring from changes in working capital. Okay, so the net cash flow here it's not related directly to inventory, but yes, you can see it's related with a change in the inventory level or a negative of that. So if inventory is accumulated, cash flow goes down. So the operating cash flows that we talked about are measured using 3 ways. The first is direct, like we said. It's revenues minus cash minus tax. That's the operating cash flow. And then operating cash flow can also be calculated using profit after tax. So remember, depreciation is the non-cash. So the profit after tax that we report as accounting will add depreciation to it because depreciation is non-cash. Essentially, the cash generated is more than the profit by that depreciation amount. And the most indirect is revenue minus cash expenses times 1 minus tax rate plus depreciation times tax rate. So this is the operating cash flow that is generated. So we're going to use the most straightforward one to use in real life is the profit after tax plus depreciation. And for this illustration, we're just going to use the direct one. So because we are creating those in this example. So here is the idea of operating cash flow. So let's assume that there's no revenue generated at period 0 when we set up the project. But by the end of the first period, we've started to see revenue. So revenue is 71875. It's all given here in this left column. Year 1, year 2, year 3, year 4, and year 5. And as you can see, we're winding down the project, so the 5th year revenue is slightly lower. I mean, it's not universally applicable, but in this case, we just assume that that's the case. And then the expenses allocated. Let's assume this is all cash. No credit sales, no purchases on credit, etc. So then this is the depreciation. This is the pre-tax cash flow, and this is the after-tax cash flow. Tax rate is assumed to be 20%. So we use these operating cash flows as we've calculated here into our next sheet. So the setup cost is 75,000 and negative, and the liquidation value net of taxes is 6,000. And the cash flows that we just showed are also net of taxes, and therefore are listed here. The working capital investments that we talked about, -7, -5. Let's just assume that we liquidate 11 of the inventory, not 6, as we saw in the previous slide. So this is investment in the working capital, and this is the disinvestment in the working capital. And the total cash flow is a sum total of operating cash flow, working capital cash flow, and the capital investment cash flow. Let's assume we already had the $75,000 and we did not have to make any new financing cash flows. That would also be a thing. So the initial setup cost is 82,000, and the cash flows that are generated are 6,000, 31,000, 31,000, 31,000, and 33,000. Primarily on an account of greater liquidation value of capital and working capital. And if we use the same NPV formula that we've seen before, NPV at the rate of 10%, so 0.1, and then these cells and add the 82,000 afterwards, we get a net present value of 14,000. So this is how a project is assessed, evaluated in a company in the real world. To conclude, we saw that accounting profits and cash flows give us different answers when net present value is calculated for each of these. We've also seen the difference between real versus nominal cash flows and how we can actually get the same answer using each of these. And for net present value, we have described cash flow estimation. We have conducted a net present value analysis on that cash flow estimation, and based on that net present value, we have recommended the feasibility of a project. And that's chapter 9. Thank you for listening.